This is a little more complex for the average user. The idea is sometimes you need to know how much something will cost over a long period of time, say 5, 10, 20, 35 years. Sometimes you're talking about a loan. You might have to take a loan out for your personal or your business needs. Imagine you have a 5-year loan of a certain amount of money. Let's say it's $100,000. Okay, so I'll just say principal will be 100. I'll put that over here actually. No, there we go. So the principal is the amount. It could be amount you borrow. That's one example. The other thing, you could think of it as, if I put the same amount of money in the bank, I could say that's my starting value in a bank account. How much will it grow? All of this has to do with companies when they want to make a long-term capital expenditure. Say they're going to buy a large machine for a factory, buy a building, some land, anything that's over a long period of time. You either receive payments or you make payments, and there's often interest. Let's pretend there's an interest rate. Let's say it's 10%. I can enter that like this, 0.10, or if I take the number 10 here, I can go back to the home screen and change it to a percent. Here's one way to do it. Now I don't want that. I want 10, right? So I can say 10%. Another thing I can do, you can see this here, I can change it. I can say format as a percent. So if I just enter the number 10, okay, and I hit the enter key so it knows it's a number, and I say format as percent. Now here, obviously that's too big. I don't want 1,000%. So here should be 10%. So sometimes when you enter it, it's not what you expect. Notice there's more than one way, I'll erase these, to get 10%. I just want to give you an interest rate. If it's a 5-year loan and I pay only once a year, the number of periods of interest will be 5. If I paid twice a year, the number of periods for a 5-year loan would be 10. So you need to know what this means. Present value is the value today. So if I put some money in the bank, let's say I put some money in the bank, then the present value is my starting amount. In this case, let's pretend it's 100,000. The future value is what will it be worth in 5 years? Or if it's a loan, what will the amount I pay off be? There's also a payment. I can figure out the payment amount I'd have to make. Say I took a mortgage out, 30-year mortgage for $300,000. How much would the payment be? So I can check that out with these finance functions. So here's the idea. I'm investing some money. Say it's $100,000. And I want to know, say I have a 10% interest rate, doesn't matter, and how much will it be worth in 5 years? So how much will it be worth is future value. So I'll tell you that. Future value equals how much it is worth or how much it will cost, depending on whether you borrowed the money or you have the money in the future. So here, future value. So here I do equals FV, future value of an investment, or if I borrowed money, how much I'll pay. Periodic means I pay them over, whether it's a month or a year or quarterly. They're regularly occurring more than once. And constant means it's the same amount. It doesn't change. So here I'm going to say I have, again, rate. There's my interest rate. I can put 0.1 for 10% or click in this cell. Number of periods. Here, 5 for 5 years. Click in that cell. Payment, I'm not asking for that, so I'm going to put 0 for now. Now notice that this is present value here. It's in these brackets, meaning optional. Right now, you either put in the payments or you put in the present value. I'm going to put in the present value. Click. And that was optional, and the type has to do with whether I make the payment or receive the interest at the beginning of the period or at the end. Since the default is at the end, I'm saying at the end of each year I pay. So I'm going to do that. Okay, so now it gives me, now why does it give me a negative? It has to do with the fact that Excel is assuming that I borrowed the money, that is, have to pay it. So here, usually what you need to do is think backwards when you're using the Excel. You say the present value. Usually they're saying put it as a minus showing that I invested it, and then it shows me how much I will get to return to me. So the positive value in these is I'm going to get that much money if I invested $100,000 for 5 years at 10%. That's the future value. Now let's say I said, okay, what would be the present value if I hope to get in 5 years something? So present value, say it's 10% again. Say it's 5 years again. Now, I won't give you the payments. Let's say, what would the present value be? In other words, how much would I have to put in an account today to have $100,000 in 5 years? So in this case, I'm going to put the $100,000. I'll put it here, but I could put it in a cell. There we go. So the rate is the first cell. Number of periods, I didn't put payments. Future value, and I'll hit enter. So this is how much I need to invest today to get the amount of $100,000 in 5 years at 10%. Again, it's a negative because you invest it, and in order to get a positive, that's money coming back to you. So I would invest $62,092 in order to get back $100,000. In other words, if I had to save for retirement and I could put this money in the bank, this is how much I would get in 5 years. That's what it means for this calculation. What's the present value of something that's worth $100,000 in 5 years? There are some other and related information. We could compute the payments. If we took out a loan or mortgage, we would use the payment function. Another related is net present value. Net present value, something like when a company invests in equipment, it equals net investment. So we have an investment now in the equipment, which is represented negatively. Then as the equipment is used, we have revenue streams each year. So if I buy a big piece of equipment for a factory and it's going to work to make a product, I put the investment now as a negative because that's cash out. And I put the revenue that the product it creates gives my firm as a positive. So I have the investment now plus revenue. And then at the end, I might get a little bit of salvage value. So at the very end of however many long it is, I might sell it for a low price. That's the idea. Net present value means the investment is negative and you add it to the revenue over time plus the salvage value at the end of its life. So that is the NPR value, and that's the NPR, net present value of an investment. Discount rate is the interest rate. Future payments, if I make future payments on it, I make them negative. If I don't make future payments because I paid for it in full now, then it's just the revenue becoming positive. That's what net present value is. Because I didn't put anything in here, it's going to say name. So what I'll do is put a quote mark here just so you can see the formula, although I didn't put numbers in it. There it is, net present value. Other formulas that are very useful. Here's another one. Payment. Payment for a loan based on constant payments. So if I take out a mortgage, okay, I want to know if I take out a mortgage, let's say it's at 5%, would be 0.05. If I take it out for 30 years, let's say I have to pay every month, then guess what? I have to do 30, right, times 12 to get how many of the payments there are. The present value now, how much did I get now? Let's say I took out a $200,000 mortgage. Okay, there it is. So that's a lot of payments. Okay, that's how much payments I'm going to have to be making. So I took out a $200,000 mortgage for that many. Oh, here's another thing I need to do. Notice I put 5%. That's your annual. I have to divide that by 12 because I have monthly. So when you have monthly payments, you take the annual interest rate and divide by the monthly number of 12. You multiply the number of periods by 12. What that tells me is that's my mortgage payment for that mortgage each month. That's how you can calculate your mortgage. So these finance functions, yes, companies use them for long-term expenditures, but people can use them when you buy a house or a car, and you can figure out your payments. There are a few other functions lesser used by the regular user, but often used by people working in finance. So there's a depreciation method. We have several depreciation methods. Commonly, if you're doing accounting for your firm, you'll use what's called the straight line. Straight line depreciation, the idea is when a company buys an asset, a table, a chair, a building, a computer, over time, we need to represent the fact that the asset wears out over time. Now, I'm not talking about someone damaging it. I'm just talking about the fact that when you buy your computer today, next year you can't sell it for as much. That's depreciation. So Excel does provide some forms of depreciation. The most common one, straight line, is like this, SLN. There it is. That's the most common one you're going to want to know. Okay. Notice we need to know the cost. So when you do straight line depreciation in accounting, you need to know how much you paid for the asset. So let's say I paid $120,000. Let's say it was a large factory machine. Let's say at the end of a useful life of 8 years, I can only sell it for maybe $6,000. It's not much. And say it has 8-year life. This tells me how much an accountant will need to record as annual depreciation. That is the most common type of depreciation. Another type, much less common, is called double declining balance. And they do have that. Okay, they have this function. There we go. Again, this is less often used, but if you're taking an accounting class, yes, you'll have to know what it is. And again, notice it takes the cost, the salvage, the life, etc. It's the same idea, only double declining balance takes the straight line percentage and doubles it so that the asset is depreciated twice as fast and therefore represented as becoming less useful more quickly than the standard, which is straight line depreciation. There is also an older and now hardly ever used method that Excel still supports called sum of the year's digits, and the function is SYD. Again, this is also a method that companies use to depreciate assets. If it happens that you're in a company that uses this method, which we really don't use very much anymore, there is an Excel function for sum of year's digits. There's also one for double declining balance. The most useful one, straight line, is the one that most companies use today. There are many other financial functions in Excel, many more than a beginning user would want to know. I just want to let you know they're there for your use, but most beginning users aren't going to need to know more than the ones I've shown.